We just finished going through Amazon's 2026 Q2 earnings call materials, and now we want to share our takeaways with everyone. Here's the question you're probably already asking. AWS just posted its best growth in 18 quarters, so why does anybody sound worried? That's exactly what we're cracking open today, and I'm going to walk you through it slowly, piece by piece. Because in the same materials, full-year capital spending went up by $20 billion, and the reason given was not demand. Sit with me for a bit. This one's worth doing properly. Let's start with the two numbers that matter, and I want you to hold them side by side. First, AWS grew 36.7% year over year, which the company describes as an 18-quarter high, and operating profit was up 43%. Take a second on that pairing. Profit growing faster than the top line means the machine is getting more efficient, not just bigger. Now the second number. Prior full year 2026 capital spending was guided at $200 billion, and the revised figure is $220 billion, and the company is explicit about why. That $20 billion hike is not driven by surging demand. It is driven entirely by component inflation, memory, and storage. I want you to notice what just happened there because most people will skim right past it. The central question of this quarter stopped being how fast revenue is growing. It became what the structural return on invested capital actually is. Those are two completely different investment cases, and the company moved the goalposts itself. Stay with me on that one because it shapes everything that comes after. Before we go anywhere else, let's get the machine clear in your head because the company describes three distinct engines. E-commerce, which it labels heavy asset logistics, warehouses, trucks people, and it says same-day fresh delivery now covers 300 cities. AWS, labeled the profit engine with an AI run rate the company says exceeds $25 billion. And advertising, labeled the margin booster with custom silicon, tranium, and graviton scaling to protect margins. Now here is the part I really want you to absorb, and it's the company's own conclusion. AWS drives the operating profit, but ads and retail generate the underlying frequency and the cash flow that fund the capital cycle. Read that again in your head. The business that makes the profit is not the business that pays for the build-out. Our take is that this is the single most useful framing in the entire report, because when you start worrying about that $220 billion, it tells you exactly which engine to go and check first. This is the one I'd slow right down for, because it explains almost every argument you'll hear about this stock. The company splits capital spending into two life cycles with completely different risk shapes. Data centers, which it calls irreversible risk. Capital gets locked roughly 2 years before any revenue begins, and the lifespan is 30 years or more. Servers, which it calls agile risk. Procurement happens months ahead, based on actual demand visibility. Payback there is under 3 years, and after that you get 2 to 3 years of pure cash flow. So here's the friction, and the company names it plainly. It is a timing mismatch. The market is watching enormous capital flow out right now, while the 30-year rent collection hasn't started yet. Which is exactly why the company says AWS operates like a power plant, not a software company. Think about a utility building a plant. Nobody calls it a disaster in year one because the meters aren't spinning yet. Same shape, different industry. Now let's clean up the profit number together step by step because the headline has some help baked into it. Headline operating profit was $27.5 billion, up 43%, and two items inside it are flagged by the company itself. A $600 million tariff refund, described as explicitly non-recurring, and a $600 million energy contract valuation described as an accounting anomaly. Add them up and you get $1.2 billion, which the material says is 4.4% of operating profit, and that buffer vanishes next quarter. So do the subtraction. What's left is the number your model should be built on, not the headline. But here's where I'll give the company real credit, because the bears are going to overplay that 4.4%. The material says the underlying leverage remains intact, and it cites Profitero data showing Amazon holds average selling prices 14% below retail peers by absorbing costs rather than passing them on. That's a moat you can actually verify from the outside without taking anyone's word for it. Strip the sugar out and the structure is still standing. Let's look at where that acceleration physically came from, because a percentage on its own tells you nothing. The company reports a quarter-over-quarter absolute revenue jump of $4.6 billion, which it describes as 1.8 times the historical record. Not 1.8% above the record, 1.8 times it, and on a base that was already the largest in the industry. Then it walks you through the loop. iPost training and agent deployment run efficiently on CPUs, specifically Graviton, which the company says delivers 30 to 40% better price performance. That in turn drags core cloud consumption along with it, and the material puts a number on why the headroom exists. 85% of global IT is still on-premise. So the company's conclusion is that AI and core cloud do not compete for the same dollar. Every dollar spent on AI post, training, or agent tools automatically pulls core cloud consumption with it. Our read is that the 85% figure is the quiet load-bearing assumption in this whole story, and I'm maybe 70% convinced if that migration stalls, the loop stalls with it. Worth knowing which brick you're standing on. Now I want to teach you how to grade a growth story, and conveniently the company hands you the answer key. Pillar 1, the backlog at $496 billion with triple-digit annual growth. The company labels it a highly verified fact and says demand is structurally outpacing capacity planning. Pillar 2, book capacity. Most of 2027 is already booked, 2028 is highly reserved, and it's labeled a verifiable contract, and it comes with a striking note. Even $220 billion of spending cannot fulfill all near-term demand. Pillar 3, the trillion-dollar ceiling, which is management's long-term vision, and the company labels that one an unverified outlook, aspirational framing, and says plainly it should not be modeled. Stop and appreciate that for a moment. A company voluntarily telling you which of its own claims you should keep out of your spreadsheet. The conclusion the material lands on is the honest one. Demand is verified, and the risk lies entirely in execution and cost. Our take, that is a far better problem to have than the reverse. Let's take the competitive position apart because it's built in 2 layers and each one does a different job. The upper layer is software, Bedrock plus agent orchestration covering security, identity, and payments, which are precisely the things that stop enterprises from deploying agents at all. The company says its Kiro coding agent is 50% more cost-effective. The lower layer is silicon, running at a $25 billion plus run rate. Trainium has secured multi-gigawatt commitments from Anthropic and OpenAI. Graviton has 98% penetration among the top 1,000 EC2 customers, with quarter-over-quarter commitments up nearly 3 times. And here's the strategic line I want you to hold on to. The company says AWS sells optionality. It stays the premier host for NVIDIA hardware, while quietly scaling its own silicon to compress inference costs across the ecosystem. Our read is that this is genuinely clever positioning. You don't have to bet on which chip wins, because you're collecting either way. Here's a connection most people miss completely, so let me walk it through slowly. Advertising came in at $98 billion, up 26%, and the company says sponsored prompt conversions are up 48%. Its own framing is that AI is not just a user interface layer, it is a direct ad conversion steroid. Now the other side of it. Fresh Grocery covers 200-300 cities, monthly active fresh customers are up more than 50% year to date, and fresh orders carry 3 times the item count of a standard order. And the company joins the two with one sentence. Frequency is the fuel. Fresh Grocery creates the high-frequency site visits required to power the ad engine. Think about your own week for a second. You buy a television maybe once every 8 years. You buy milk every few days. So groceries here aren't really a grocery business. They're an attendance business, and advertising is what monetizes attendance at very high margin. Our take, that's the most underrated sentence in the whole report. Now the company does something I wish more of them did. It sets management's claims directly against a skeptical reading of each one. On growth, management says the AWS acceleration is structural. The counter reading agrees, given the massive base, but says Q3, the first quarter without Prime Day interference, is the ultimate test. On CapEx, management says there's a clear 3-year return formula. The counter reading says the mechanical formula is sound, but memory inflation just increased the denominator, and the impact on payback periods remains unquantified. Sit with that word for a second. Unquantified. Not disputed, not denied, just never measured out loud. On AI, management says AI lifts core cloud. The counter reading agrees, then names the double-edged sword. If AI adoption cools, both the inference engine and the core cloud engine decelerate simultaneously in the same direction. To be fair to management, all 3 of their claims get graded as true. Our take is that the disagreement here is never about direction. It's entirely about timing and magnitude. You can read a management team by which questions they answer cleanly, so let's actually count them. The company logs 10 total analyst questions and sorts them into 3 buckets. Evasive on CapEx and funding, 4 questions, the single biggest block. Management refused to give timelines on slowing data center spend or specifics on funding sources. The quoted answer was, "We have options, nothing to share." Direct on AWS margins, 3 questions. Management confirmed 520 basis points of structural margin growth excluding accounting effects, and openly forewarned of future volatility depending on product, mix, Mixed on AI strategy, 3 questions. They confirmed development of in-house frontier models, but evaded the return question around third-party Trainium sales. Now put those 3 together and look at the shape of it. They were most confident about what has already happened, and most evasive about what they have committed to spend. Our read is that a 4-question evasive block on funding isn't an oversight. That's a decision. This is the arithmetic at the center of everything, and it's simple enough to do in your head. The company sets it out as an equation. Fixed long-term contracts plus rising memory and SSD costs equals compressed ROIC. Here's why that first term matters so much. Management admits components are at peak pricing, but cannot pass those costs on to customers already locked into multi-year contracts. So the revenue side is nailed down while the cost side floats upward. That's the entire problem in one sentence. Which brings you to the conclusion the material states outright. The 20 billion CapEx hike does not buy more revenue capacity. It means the exact same capacity now costs more. The absolute return shrinks while the capital outlay expands. And to be fair, this is a cost cycle. It's not a broken business. Memory prices have come down before and they will come down again. But our take is that you should not model this as growth spending. Model it as inflation, because that is exactly what the company called it. 4 open risks, and I want you to weigh them by how fixable each one actually is. First, the free cash flow headwind. The CEO explicitly warned of a drain from CapEx, $53.1 billion in Q2 alone, and provided zero timeline for a reversal. Second, and this is the one the company itself calls the blank check. The funding source for the full $220 billion remains completely opaque, and the debt issuance strategy is unconfirmed. Third, the Q3 deceleration trap. Revenue guidance implies a slowdown, and the material says the cited adjustments, the prime day shift and an 80 basis point currency drag, do not fully math out in the public data to close the gap. Fourth, the dumbbell demand curve. Strong demand at the AI lab end, basic cost cutting at the other end, and the massive middle-tier legacy workloads moving to inference is described as speculative. Even the CEO admitted uncertainty about its slope, which I'd rather hear than a confident guess. Our take, 3 of those 4 are timing problems. The blank check is the one that's a choice. Let's score management the way you'd score a balance sheet, which is exactly how the company frames it. On the asset side, transparency. They maintain the aggressive 2027 capacity, doubling goal despite inflation. They proactively admitted upcoming free cash flow headwinds and margin volatility without being prompted. And they honestly admitted uncertainty about middle-tier enterprise demand. That third one is rare, and I want to be honest about my own record. I've written management teams off for admitting uncertainty, and I was wrong to do it. Saying you don't know is usually the most trustworthy thing anyone says on one of these calls. On the liability side, omissions. Absolute silence on specific funding sources for the $220 billion. No timeline for when data center spend might decelerate, and a refusal to quantify the ROIC compression caused by hardware inflation. The verdict the material reaches is one I'd sign my name to. High disclosure quality on operational reality, deliberate obfuscation on capital structure. Now let's define the actual risk, because the headline number is misleading and the company says so itself. That $220 billion splits into 2 very different kinds of money. Servers are agile risk, procured months in advance, and the company says it can hit the brakes instantly if demand cools. Low structural risk. Data centers are irreversible risk. A 2-year lead time, and once the ground is broken, it cannot be stopped. And here is the bet, stated plainly. Middle-tier enterprise demand must ignite before that 2-year data center build phase concludes. So the true risk exposure is not the whole $220 billion at all. It's the long-tail physical infrastructure being built for a middle-tier demand that is still unproven. Hold on to that distinction, because it's the difference between a company that overspent and a company that mistimed. I'll take the first one is fatal and the second one is just painful. This looks like the second. Finally, the company hands you a Q3 dashboard, 8 things to watch. And honestly, this is the part worth writing down. 1. AWS growth, the first clean quarter with no prime day distortion in it. 2. Operating margin, which must hold the 520 basis point baseline excluding accounting effects. 3. The funding announcement, meaning debt issuance details, which the company calls the biggest catalyst for a re-rating. 4. The free cash flow and CapEx scissors, and note the instruction carefully. Watch the spread converging, not the absolute numbers. 5. Memory prices, which will dictate further CapEx revisions and the return formula itself. 6. Backlog velocity, the leading indicator of middle-tier enterprise demand igniting. 7. Trainium external sales, described as a potential hidden variable that could repair ROIs through a second revenue stream. 8. Tariff impact, watching base margins closely as that 600 million Q2 buffer vanishes. Alright, last thing, radar always leaves you a light. I'm calling this one yellow, and let me be precise about why. The business is genuinely excellent. 36% growth on that base, a 496 billion backlog, 98% graviton penetration, price is 40% below peers. Nothing there is broken. What holds you back is one single thing. They raised spending by 20 billion because inputs got more expensive, then went quiet on how it gets funded across 4 separate questions. I can't grade a return when the cost of the capital behind it is undisclosed. Here's what flips me, and I'm saying it in advance so you can hold me to it. If Q3 delivers clean structural acceleration with no Prime Day help, and they name the funding plan, I go green. If the funding stays blank while CapEx keeps climbing, I go red. If you like this kind of analysis, the kind that does not ride the market's mood and stays locked on industry data and hard logic, please subscribe to Value Stock Radar, hit the bell, like and share. Your support is what keeps us digging through the financials and hunting down quality names. This is Value Stock Radar. See you next time.